Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of debt financing versus equity financing. How to choose the right option for your business. Ownership and control. One of the most important aspects of equity financing is its impact on ownership. By selling shares, you're essentially sharing a piece of your business. This can mean giving up some control, depending on how much equity you choose to sell and who you sell it to. For example, angel investors or VCs may require a seat on your company's board or a say in major decisions. Publicly traded companies are accountable to shareholders who may influence company policies through voting rights. While this can bring valuable perspectives and expertise, it also means founders need to balance stakeholder interests with the company's vision. The level of control you maintain often depends on how much equity you're willing to part with. Selling too much could leave you with a smaller voice in your own business, while holding on to too much equity might limit the funds you can raise. Advantages of equity financing. Equity financing comes with several distinct benefits that make it a popular choice for businesses. No repayment obligation. Unlike loans, there's no need to pay back money or worry about interest rates. The funds you raise are yours to use for growth. Access to expertise. Many investors, especially angel investors and VCs, bring valuable experience, business connections, and industry knowledge to the table. Growth potential. Equity financing often provides much larger sums than debt financing, especially for fast-growing startups. This capital can be transformative for scaling operations or entering new markets. Shared risk. Since investors share in the business's success, they also share the risks. If the company struggles, there's no repayment burden. Improved credibility. Securing investment from reputable sources can enhance your company's credibility, making it more attractive to future investors or partners. While it requires giving up some ownership, these benefits make equity financing a powerful option for businesses focused on long-term growth and innovation. Key differences between debt and equity financing. When deciding between debt and equity financing, it's crucial to understand how each option uniquely impacts risk, cost, and operational control. While both provide necessary funding, they come with different trade-offs that can influence your business in the short and long term. Let's break down these differences across 3 critical areas. Risk and obligation. Debt and equity financing come with distinct levels of risk and responsibility for your business. Debt financing. Borrowing money means creating a legal obligation to repay it, regardless of your financial situation. Missing payments can harm your credit score or lead to legal consequences. This fixed repayment schedule increases financial pressure, especially during slow revenue periods. However, it doesn't impact your ownership or decision-making power. Equity financing. With equity, there's no repayment obligation. Investors share in your risks and rewards. If your business struggles, you won't owe them a fixed sum. That said, you give up partial control of your business. Investors may influence decisions, which can feel risky if they have priorities that differ from yours. The choice comes down to how comfortable you are with fixed liabilities versus shared decision-making. Debt offers stability in control, while equity reduces financial stress during tough times. Cost of capital. The cost of capital is another key factor where debt and equity differ significantly. Debt financing often carries lower costs in the long run. Interest on loans is usually tax-deductible, giving you a financial break. Once the debt is repaid, your obligations end. However, failing to repay can bring additional penalties and higher interest rates, increasing costs down the road. Equity financing initially appears free since you don't have to make regular repayments, but it involves giving away a share of future profits. This can become expensive if your business grows significantly, as investors continue to claim their share indefinitely. Debt is like renting money for a set price, while equity is like selling a permanent piece of your business. The better choice depends on your cash flow and growth plans. Impact on business operations. How these financing options affect your operational flexibility and decision-making is critical for determining the right fit for your business. Debt financing. With debt, you maintain full control over your company. Lenders don't interfere in your operations, they're only concerned with repayments. However, debt can limit your flexibility. High monthly payments can strain cash flow, making it harder to invest in new opportunities. Equity financing. Equity comes with fewer financial constraints, freeing up cash flow for growth. But it also introduces additional voices into your business. Shareholders or investors may want to weigh in on major decisions, which can slow down processes or shift the company's direction. In short, debt financing provides operational autonomy at the cost of financial flexibility, while equity financing offers financial breathing room but requires collaboration with investors. When to choose debt financing? Debt financing isn't a one-size-fits-all solution, but there are situations where it clearly makes sense. When your business has predictable income, manageable costs, and specific funding needs, borrowing money can help you grow while keeping full control. Let's break down 2 key factors to assess when considering debt financing for your business: business stability and cash flow. Before taking on debt, your business needs stable cash flow and consistent performance. Why? Because lenders expect regular payments regardless of how your business is doing. If you're juggling unpredictable revenue or seasonal income, debt might create extra stress. But if your income is steady, debt financing can make sense. Here's what to consider. Can you handle monthly payments? Loans and credit lines require timely repayment. If your cash flow comfortably covers these payments, it's a green light. Is your revenue stable enough? Look at your past 6-12 months of financials to spot patterns. Consistency is key. Do you have predictable expenses? If you don't face unexpected cash drains or wildly fluctuating costs, debt is easier to manage. For example, a retail store with regular sales or a manufacturing company with ongoing contracts would be strong candidates for debt financing. Reliable revenue means you can confidently meet payment schedules without cutting corners elsewhere. Interest rate environment. Interest rates play a huge role in choosing debt financing. Simply put, the higher the rate, the more borrowing costs you'll face. Paying attention to market conditions can help you decide when to act. Here's how interest rates affect your decision. Low rates reduce borrowing costs. When rates are down, loans are cheaper. Your monthly payments stay manageable and you pay less in the long run. High rates mean sharper costs. Borrowing during high-rate periods can strain your finances, especially if your margins are tight. For example, let's say you're considering a 5-year loan. Locking it in during a low-rate market could save tens of thousands compared to waiting until rates rise. Timing is everything. If rates are favorable now, it might be better to secure funding, even if you don't urgently need it. On the flip side, if interest rates are high, you might look at options like equity financing or delaying your funding needs. Debt financing works best when you pair stable cash flow with favorable interest rates. These 2 factors together keep borrowing costs low and repayment manageable, setting your business up for success. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.